I predict Charlie's going to talk about Costco. Go ahead, Charlie.
Well, Costco, of course, is a
Charlie and I were on a plane recently that was hijacked.
with what?
It was hijacked. I'm telling you about our experience on that hijacked plane when the hijackers picked us out as the two dirty capitalists that they really had to execute. But they were a little abashed about it. They didn't really have anything against us. So they said that each of us would be given one request before they shot us. And they turned to Charlie and they said, "What would you like as your request?" Charlie said, "I would like to give once more my speech on the virtues of Costco with illustrations." And the hijacker said, "Well, that sounds pretty reasonable to me." And he turned to me and said, "And what would you like, Mr. Buffett?" And I said, "Shoot me first."
Hey guys, welcome back. In this video, I want to show you some clips of Warren Buffett sharing what he thinks is the best passive investing plan for most people. I'll be reacting to Buffett's clips, and I'll also show you how this plan would have performed using a compound interest calculator. As always, if you enjoyed the video or if you learned something new, please consider hitting that like button and subscribing to the channel. So, passive investing is probably one of the simplest and most rewarding investing plans out there. And it's the strategy that Warren Buffett and other great investors recommend to the majority of people wanting to invest in the stock market.
Yeah, I would say that in terms of the index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all my money in at one time. If I were going to put money into a index fund in relatively equal amounts over a 20 or 30-year period, I would pick a fund. And I know Vanguard has very low costs. I'm sure there are a whole bunch of others that do. I just haven't looked at the field.
So one of the most important points Buffett made there was about not putting all of your money in at one time. He says if he was to invest in index funds, he would slowly invest his money over a long period of time. Essentially, when you buy index funds or ETFs, you have a choice. You can invest all your money straight away in one go, invest your money over time piece by piece, or hold all of your money in cash and wait for a big market crash so you can put all of your money in at the bottom. The last idea should be scratched from the list immediately because nobody can time the market. It's impossible to know when a big market crash will happen, so sitting on the sidelines holding cash and trying to time the bottom is not a great idea. Peter Lynch says more money has been lost trying to predict market crashes than the crashes themselves. There's a wise saying that time in the market beats timing the market, and that couldn't be more true. So we're left with our first two options. Out of the two, the first one is definitely more aggressive than the second option. Putting all of your money in one go can be pretty risky, especially when the market's at all-time highs. If we look at a chart for the S&P 500, I'll show you two examples where lump summing all of your money in at one time can be a really good idea or a really bad idea. Alright, let's say we're back in 2000 and you wanted to invest in the S&P 500 index. And let's say you decided to lump sum all of your cash in at once. If you had done that in early 2000, you would have had a negative return for over 10 years, and you would have waited 12 years just to break even and be exactly where you started. On the flip side, let's say we're in 2009, and you decided the same thing again, but this time you lump summed all of your capital here at the low point of the market. Since then, your results would be awesome, and you'd be up around 500% in 11 or 12 years. The point I'm trying to make is, lump sum investing can be really good or really bad. And it depends on how lucky you get with the timing, which means you're indirectly trying to time the market. I'm not saying don't lump sum ever, but pretty much the only time I'd ever consider it is right after a big market crash, like in 2008 and in 2020. So that leaves us with one option remaining, and that's to put our money in slowly, piece by piece over time, which is something known as dollar cost averaging. Dollar cost averaging is where you invest the same amount of money every time period of your choosing. So it can be every month, every 3 months, every 6 months, or every year. It's completely up to you. But the point is you invest the same amount no matter what. In a market where we go through lots of ups and downs, dollar cost averaging is a great strategy to take advantage of these declines. And it allows us to buy more of the market when it's down and less when it's up. Over time, buying more shares when a market is down and less when it's up lowers your average cost per share. If we look at this example, Mr. White did a lump sum investment when it was $10. So his average buy price is $10. And this particular stock went up and down and it ended up back at $10 again at the end, leaving Mr. White with a 0% return. Next we have Mr. Green. Mr. Green is dollar cost averaging every month to take advantage of possible declines. He also starts off buying shares at $10, but he also invests the same amount each month and he buys shares at $20, $7, $15, $5, $6, $6.5, and finally $10 again. And at the end, because Mr. Green bought more while the stock was down and less while it was up, his average buy price was $8.16. So at the end, when the stock was backward started at $10, Mr. Green was actually up 20%. This is just a basic example of how dollar cost averaging works, but it can be a very useful plan for most people, especially because most everyday people don't have hundreds of thousands of dollars to lump sum anyway. Most people who want to passive invest are only able to set aside a percentage of their paycheck every month, which makes dollar cost averaging the ideal strategy. In reality, let's say you invested $1,000 a month into a low cost index fund, and this index fund generated a return of 10% a year, which is historically what the S&P 500 index has returned the last 100 years. If you kept doing this month in, month out, after 25 years it would compound to nearly 1.2 million. And this was achieved with basically no effort at all. You never had to look at a single headline or read an annual report. You just had to jump on your phone once a month for about 5 minutes and buy some shares. The beauty of dollar cost averaging and passive investing in general is its simplicity. According to Ben Graham, the main objective of passive investing is to free the investor from bother. And these days, literally anybody can do it any time on their phones with apps like Stake. There's so many other benefits to being a long-term passive investor other than being free from bother. It's also extremely tax efficient. In Australia, there's a neat little tax rule where if you hold an asset for 12 months or longer, you get a 50% discount on your capital gains tax when you sell, which is really good, and it could save you tens of thousands of dollars down the line. But the best thing by far about passive investing in ETFs is the low fees. Most broad market ETFs or index funds charge really low fees for managing the fund. They just copy the benchmark index that they're tracking, and they do all of the work when companies are added or removed from the underlying index. Out of all the ETF providers out there, I think the lowest fees has to go to Vanguard and BlackRock. They both offer a huge range of broad market ETFs for ridiculously low fees. You can track the Australian market, the US market, and you can even track the global market with a global ETF. There's so many types of ETFs out there now that it can get pretty overwhelming trying to decide which ones to buy, how many you should own, and what allocation each one should be. There's literally hundreds of ETFs tracking different types of markets, so it can get pretty jarring trying to narrow it down. Let's listen to a short clip from Mohnish Pabrai and see what he says.
And in terms of index funds, S&P 500 or...
I'd say Vanguard is a great way to go. I think you could do S&P 500 index, you could do the Russell 2000, and if you wanted to, you could do an emerging market index. But I think if you just blend those three, 1/3 each, you're done. And if you're in your 20s and you start doing this, you don't need to even go into bonds and other things. You can just do this for a long time and you'll be fine.
So according to Mohnish, just 2 or 3 broad market ETFs and then you're done. Owning too many ETFs can actually be detrimental to your returns because of high brokerage fees. If you own 10 ETFs and you dollar cost average every month, then you have to pay brokerage fees 10 times a month for every trade. So I think 4 broad market low cost ETFs is plenty for a long-term passive portfolio. It keeps things really simple and easy to keep track of, and it keeps the fees nice and low. And according to Buffett, this strategy has worked wonders since 1942.
1942, when I bought my first stock, as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now.
So $10,000 to $51 million. That's absolutely insane. But it did take 80 years, and some of us don't have that long, or we don't want to wait till we're 100 to be rich. But with dollar cost averaging, if you were investing $1,000 a month, over time you'll put in much more than $10,000, which means it takes a lot less time to compound into a considerable amount. In this interview, Mohnish Pabrai tells a story about Charlie Munger and the inevitability of getting rich if you follow this plan with discipline.
Charlie Munger was asked at one of the Berkshire annual meetings by a young man, how can I get rich? And Munger's response was very simple. He said, if you consistently spend less than you earn and invest it in index funds, dollar cost average, because you're putting in money every paycheck. Mm-hmm. He said that in about 20, 30 or 40 years, you can't help but be rich. It's just bound to happen. And so any individual investor, if they just put away 5, 10, 15% of their income every month, and they just bought into the low-cost index funds, and just 2 or 3 of them, to split it amongst them, you're done.
If you've watched the video up to this point, thank you so much for watching. If you enjoyed the video and you want to support the channel, I'd really appreciate it if you hit that like button. And if you want to see more videos like this one or join our community, hit that subscribe button. If you want to know my favourite Australian broad market ETFs, I'll put that video up in the corner. And if you have any questions, please don't hesitate to let me know in the comments below. I reply to every single question. And as always, this video is not financial advice. Please always do your own research before making any investment decisions. Thank you guys so much for all of your support, and I'll see you guys in the next one.